Good morning. My name is John Von Paris, and I am the chairman of the MDTA Finance Committee. I hereby call the meeting of the Finance Committee to order at 9:01 a.m. In accordance with the live streaming law, this meeting is being conducted via video conference and is being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. I ask that anyone who is presenting or answering a question to please turn your video and audio on when speaking. When you are done, please turn your video off and put your audio on mute. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. There are no members of the public, no elected officials, and no media who have pre-registered to comment at this morning's meeting. This time we will begin with agenda item number 1, the approval of the minutes from July 12th, 2022. Is there a motion to approve the minutes?
So moved.
Second, Member Carroll.
Thank you. Any further, we have a motion and a second. Any further discussion? All those in favor?
Aye.
Aye.
Opposed? Motion carries. The minutes are approved. We will move on to agenda item number 2, the two-way communication radios for police vehicles. And Jim, are you here today?
Good morning. Yes, I am. Unfortunately, I do not have video on my monitors.
Okay, that's okay. Good morning, Jim.
So today we are asking for approval for the purchase of 56 two-way encrypted radios for installation in additional police vehicles that were collectively bargained between the MDTA and the Fraternal Order of Police Lodge 34. Currently, we only have 10 in our stores for when the vehicles come in, so the additional 56 are required for installation when the additional vehicles are eventually received. The total cost is, as you can see on summary, is $393,244.88, and will be presented to the Board of Public Works on September 14th.
Okay. Are there any questions from any of the members? Okay. I guess I have a comment, and this is a part of the overall package, I guess, and was factored in our earlier estimates and so forth of cost with this tied to the vehicles.
Yes, they're all included in the overall cost and were included in the budget for each individual vehicle.
Okay. Thank you.
Good morning.
Good morning.
This is Donna DeCerbo, Director of Procurement. I just wanted to share that we did do a price analysis and we received 30% off of MSRP for these two-way radios, and that was a comparison we did to the NASPO contract and the New Jersey contract. The NASPO contract included 27% off of MSRP, and New Jersey was 25%. So we got a better price. We got 30% off of MSRP. So the price was determined to be fair and reasonable, and procurement was happy with their proposal.
Thank you for that information, Donna. Certainly, I know
Welcome.
we always do our due diligence, and thanks for pointing that out again on this purchase. Any other questions, discussion? I guess, do we have a motion?
So moved.
Okay. Second.
Member Ardinger, I'll second.
Okay. Any further discussion? All those in favor?
Aye.
Aye.
Opposed? Motion carries. Thank you. Thank you, Jim, and thank you, Donna. We will move on to agenda item number 3, debt policy. And Alan and Dana are here to discuss that and present.
Hi, good morning. I'm Dana Tate, Debt Administrator in the Treasury Unit. The debt policy is MDTA's blueprint for financing activities and provides strategic guidelines and requirements to achieve financial strength, a high credit quality, and access to capital markets at the lowest cost of financing to fund MDTA's capital program. Some of its key sections include the debt limit, the unrestricted cash target, the debt service coverage target, and the credit ratings goal. By adhering to the policy, the MDTA continues to be a highly rated credit in the toll revenue bond sector. Following this year's annual review of the debt policy, no changes are recommended. I will now pause for any questions.
Questions from any of the members? Okay. There's no questions at this time.
Okay. We would like the Finance Committee's recommendation to move forward the debt policy to the full board for approval.
I'll move that we move that policy forward to the full board.
Okay, we have a motion. Is there a second?
Member Ardinger, I will second that.
Okay, thank you, Member Ardinger and Member Rosen. We have a motion and a second. Is there any further discussion? Okay, all those in favor?
Aye.
Aye.
Opposed? Motion carries. Thank you. Thank you very much, Dana. Okay, we will move on to on the agenda item number 4, an update on the investment committee report. Alan, Clayton, and David will present. Good morning. How are you this morning, Alan?
Great. Yeah, this is our quarterly review of investment strategy and performance. I think we're going to start it off. David Calvert of PM is joining in with us. And I think, Clayton, if you're on, you can start us off with the key points and highlight the agenda.
Thank you, Alan. Yes, we on slide 2, we want to make sure that we cover the market update. Again, we'll have David with PFM go through that for us. Then we'll talk about the portfolio composition and compliance. We'll review the strategy of the portfolios, and in addition, we'll go through the total return performance of the portfolios. I think the key points that we want to convey are that the portfolios remain diversified, they remain in compliance with the policy and the trust agreements, and that the investment strategies are consistent across the various strategies and over time. And then finally, that the multi-year returns are consistent with the starting rolling yield. That said, I will turn slide 3 over to David. Thank you for joining us, David.
Thank you. So the economy has been basically very turbulent in 2022. The unemployment rate is now at 3.5%, which is actually lower than pre-pandemic. And so far in 2022, 3.2 million jobs were added. So we're actually now at higher employment levels than prior to the pandemic. Unfortunately, inflation has run rampant throughout the economy. This is due to a number of issues stemming from the COVID pandemic. First off, the supply chain efforts, as well as the recent COVID lockdowns in China, have all escalated inflation. Right now, consumer price index prices are up 9.1% year over year, and these are at the highest levels in over 40 years. Because of rampant inflation, the Federal Reserve has had to combat it by raising short-term overnight interest rates. So far this year, the Federal Reserve has raised rates 4 times, or by 225 basis points. So the last increase occurred in the last week of July, which was a 75 basis point increase. Going forward, there's 3 more FOMC meetings, the next one occurring in September, and the markets are anticipating anywhere between 100 and 150 basis points more in hikes. These hikes are some of the largest hikes we have seen in more than 25 years. In terms of the last time we've seen a 75 basis point hike was back in 1994. So this year is definitely a very starkly different year than we've seen for fixed income bond markets. So I'll turn it back over to Clayton for the next slide.
Thank you very much, David. So just to finish off slide 3, maybe, I think the implication here is that there could be additional stress and total return strategies within the fixed income portfolios with higher interest rate moves. And you know, we want to be cognizant of that and bring it to your attention. Moving on to slide 4, we highlight the diversified nature of the portfolios. We note that there are significant allocations to agency bonds, to treasury bonds, and to the money market mutual funds. These are across, again, the total return strategies as well as some of the investments in bond service accounts. So we diversify by sector, and on slide 5, we also note that we diversify by maturity. And we note on slide 5, or we notice on slide 5, that there are significant allocations to shorter maturity instruments. And this is primarily a function of the agency's bond service assets and cash assets. You'll note that just over 500 million is in the 0 to 1 year bucket. Again, these are very short term. We would deem these as very stable investments with minimal exposure to price risk. You can see there at the bottom that you know, the capital account money's going out every month is 325 million. Debt service assets are at 89, and then operating assets, I guess we could consider that cash is at 60 million. So for monies that are being used imminently by the agency, we keep these assets very short maturity and very stable and very safe. Moving on to the total return strategies, for example, on slide 6, we see the general account, the maturities go out to 5 years. We see that we have exposure to the belly of the curve, primarily over 100 million there in the 2 to 3 year bucket. And these securities can be typically invested anywhere from, in the slide we say 3 months, but we typically will let things roll off, so they can be invested in securities anywhere from, you know, a couple of weeks out to 5 years, with an average duration or life of just under 3 years. Moving on to slide 7, we focus on a longer maturity portfolio, longer duration portfolio, the M&A. Here we have the opportunity to go out to 15 years, so the portfolio can be invested typically anywhere from 0 or a couple of weeks to 15 years, with an average duration or life of about just under 7 years. We see here we have a little bit overweight to the front end. We're always looking at this, and we're trying to duration match the index such that our interest rate exposure is de minimis. Are there any questions from your members? Thank you.
Member
Okay. Yes,
Sorry.
please.
So at the very beginning, and I think I know, but just we anticipate that the interest rates are going to be increased. So specific to us and to our investments and our issuance of bonds, what exactly, what are we looking at? What are we expecting? What can we do?
Well, related to the issuance of bonds, I'll let Dana and Alan speak to that, but related to the investments. So one of the things we've noticed is that as we've seen these rate increases, actually the belly of the curve, meaning kind of the mid maturities, that's about 3% at this point. And so I would expect, well, I guess I shouldn't say what I would expect, but I think it's safe to say that, you know, in the belly and maybe a little bit longer maturity, there will probably continue to be this flatness of a curve, meaning that the rates from anywhere from 6 months out to, say, 5 or even 10 years are fairly consistent. I'm looking at Bloomberg, and the 10-year rate is at 279 and the 6-month rate is at 310. And so I think in that area of the maturity spectrum, we'll see rates contained. Where the Fed is having its impact is at the front end. Is that not true, David?
Correct. And one of the things about the fixed income market, it actually anticipates the Fed policy even before sometimes the Federal Reserve officials actually say anything. So
Yes.
where long-term rates, especially in, let's say, the 2 to 10-year area, it's actually anticipating what the Federal Reserve may do regardless of what they're actually saying. So the markets are very intelligent in that way. And the reason why the yield on the 10-year Treasury is actually lower than the short term is that the markets is basically telling the Federal Reserve is that, okay, you're probably going to slam on the brakes, slow down the economy by these aggressive rate hikes in order to combat inflation. And then all of a sudden, there's going to be a pullback in the economy, and then you're going to have to aggressively start lowering rates. So this is one of those things where it's like we're going up a roller coaster, and the Federal Reserve is probably going to have to raise rates to maybe 3.5%, but in 2023 or definitely by 2024, they're going to have to start lowering rates. Which sort of begs to the question on why it's important to have a longer term investment strategy. And even though it might be a little bit of short term pain, you're implementing this longer term strategy because there's sometimes short term bumps we're experiencing now, but longer term, I think we're going to be better off by having this strategy. And if you want to talk about the debt policy, that definitely has a significant impact because the cost of borrowing, especially for some of our other clients, have increased substantially, and refinancing and refunding activity is quite different than the last several years.
The good news for us is we're not planning on going to the bond market in the next year. And when, just like when we look at our traffic and we'll say, you know, what's going on with traffic, we always say what's more important is what did we say in our forecast would be going on with traffic. And so in our financial forecast, we assume borrowing rates higher than the current market. You know, the more near term, that cushion, call it, is smaller. But as we assume borrowing out further, years 5 and 6, it's a little wider. So we do expect higher borrowing rates. The question is, will they come back down when we are ready to go to the market, which is not within the next year? I'm sorry, one more additional thing. One more addition. We currently do not have any refunding opportunities. And what I mean by that is we don't have any bonds where we have a call date approaching. So that's where we're not harmed from that perspective neither.
Good. Thank you.
Member Orange, does that help you?
It does, definitely. Thank you to both of you for that explanation. I appreciate it.
Okay, thank you.
So moving on, go ahead, Alan.
Just a couple other thoughts too, is that, you know, we locked in a $200 million TIFIA loan, you know, at less than 2%. So we have that advantage of having locked that in even in a rising rate environment. And rates are actually, you know, fairly low historically. And to Deb's point, they're below our forecasted financing rates. So we've got some comfort there. And then, you know, I think back on the investment portfolio is if you look at the long rates that, you know, David and Clayton had talked about are around 3%. that's really signaling the market's anticipation of, sort of what David was highlighting, that the Fed's going to be hiking, but they're going to get inflation under control, and that, rates may have to normalize in terms of the shape of the curve. Right now, it's, flat to inverted. And I think you saw that in that first graph where 2, 5, and 10-year rates are all similar. So something has to happen for that to normalize. And so that's either short rates, falling, or long rates rising from here. But, long rates have actually come down in recent weeks and are back down to, around 3% from 3.4%. So it's an interesting and volatile ride for us. And we can't lose sight of the fact that we're sort of taking a long-term investment approach and accepting this volatility, and what we expect is higher average annual returns, over multi-year periods. I'll turn it back over to you, Clayton.
Sure, and that's implicit in the discussion on slide 6 and 7. And maybe we should emphasize it, but these are two portfolios with long-term strategies, one with a 5-year maturity cap and one with a 15-year maturity cap. And so we're very cognizant and want to remind ourselves all of the time of these long-term approaches. Moving on to slide 8, this represents our compliance report. All of the holdings meet our credit rating requirements. The considerations or the concentrations are below the required limits, and we conform to all maturity requirements as well. In the top section of that table, you'll note that we're in compliance with the policy as it relates to the maturity number of years. And then further down, we go through each sector, subsector, and security type, and see over on the far right that we are indeed in compliance and have been in compliance for the quarter with respect to the trust agreement and the policy. Moving on to slide 10, I will turn this over to Alan.
Great, thank you. Yeah, the agency employs two broad strategies. One is a strategy for our reserves, or our total return accounts. That represents about $350 million of the $800+ million in the total portfolio, so a bit less than half. We're essentially reviewing that strategy quarterly at the investment committee level, and then we make a recommendation to the finance committee and the full board. Our goal is to maintain a consistent duration strategy, with a view toward higher multi-year average annual returns, while accepting shorter term volatility. And we're not trying to time interest rate moves or the market. Generally think as investors that you can predict the future very well. And I think one illustrative point is, and we'll see this with the M&O reserve, is we have very large negative mark-to-market returns in the trailing 12 months. And then, expectations for further rate hikes. It looks like the Fed's getting closer to the end. And so the return for the M&O reserve, which we're not reporting on today, but was actually up over 2% in the month of July. And I think that sort of helps to illustrate why you don't, whipsaw the portfolio and make it shorter or longer, in response to what's happening in the market, because the market can very quickly move the opposite direction. And so it's helpful to maintain that consistent strategy. And it's similar to just essentially holding a lot of the portfolio to maturity, not worrying so much about the mark to market and really focusing on, the prevailing yields that you're buying at. So for the M&O reserve, we have a strategy of a duration of approximately 7 years, and our benchmark is an index of 1 to 13-year treasury strips. It's only about 14% of our portfolio, and it's the longest, most volatile piece. The general account is benchmarked against an index of 1 to 5-year securities with an average duration of approximately 3 years. For the match funding accounts, again, that's our capital account, our operating funds, our bond service accounts. The policy limits us to matched funding investments. So we essentially match the investment maturities to those expected or known cash flows. For a little perspective, 12 months ago, prevailing money market rates were near zero, and the Maryland local government investment pool was yielding about 3 basis points or 0.03%. MLGIP is now at 2%. Prevailing money market rates are around 2%. So we're very much sort of limited to what we can invest in those accounts, and the returns are typically less volatile and positive because there's not a lot of mark to market. But when rates are extremely low, near zero, that's what we're earning. And now that rates have picked up, capital account, can reinvest those monies at close to 2%. And that's the expected return over the next 12 months for those portfolios. Moving on to slide 11, we discussed this in a little detail last quarter, and I'll just hit a couple of highlights. The top chart illustrates a yield differential between our longest benchmark and the benchmark we used for the general account. And you can see that generally the yield on the longer benchmark, like longer securities, is higher. So that's really the goal, is to try to achieve that longer term multi-year average higher annual return. But the lower chart illustrates the volatility that you're accepting with those expected higher average annual returns. And you can see the blue and the green bars below. You have returns, total returns, which is essentially your income accrual in that year, plus the mark to market. At times can be negative or positive, but you'll see that, typically that longer term benchmark is outperforming the shorter term index. I think the other points that we wanted to make here is that, we're trying to maintain a stable target regardless of what happens in the bond market. We're not trying to time the market, and we believe that we have some tolerance for accepting that volatility within our policies, and we're essentially targeting these multi-year returns that are in line with what we're forecasting in our financial forecast. I think, Clayton, I'll turn it back to you. That takes us to slide 12.
Great, thank you. Any other questions at this point? Is this a good place to pause for questions?
Any questions for any members?
Alan, just one quick question. Is there a risk with extreme volatility that the 350 million gets breached on an interim basis because of the mark to market?
Yeah, we've periodically added and taken money out of those reserves. So you're correct, as the mark to market drives those down, we add money to those reserves. So as net operating revenues flow in, we will add money to the general account and the M&O reserve to account for those mark to market declines. With the main goal at fiscal year end is we want to show that as being above 350 million. That's in our debt policy, so we're maintaining that. And I would highlight that 2 years ago, for 2 straight years, we had 4.5% returns, even though prevailing rates were only 1%. So we had a lot of mark to market gains in those portfolios, and we pulled funds out. So funds were transferred out of those 2 portfolios and into the capital account. So that's the sort of the mechanism for keeping those portfolios close to 350 million. But I think longer term, as Deb has alluded to, we're forecasting about a 1% return in those portfolios, and that's what we expect to earn over multi-year periods. And I think that's what you'll see illustrated in this chart on page 12, is that your 5-year average annual return was a little over 1%. And if you look back 5 years ago, coincidentally, that was prevailing yields at that time. So even though we had, returns of positive 4.5% in 2019 and 2020, and we had a negative return in 2021. You can see that portfolio is sort of averaging out where prevailing yields were during that time. So does that answer your question about sort of adding and putting back money?
No, Member Rosen, let me expand. Sorry. To be more specific about the 350 million in mark to market, we're not at risk of violating that policy because we are not in a place where we need to issue bonds. So we have sufficient cash to cover mark to market as well as our planned outflows for the operating and capital budget. We're at year-end bond sale. That's when we have to pay even greater attention to mark to market if we're in a volatile time period. And so because we don't have any bond sales planned, that means we have sufficient cash for the capital program and operating. If the impacts at year-end were so significant, we have enough to cover for the mark to market. And this past June 30th, that we had sufficient cash to be able to do that. So I think I was just trying to narrow more specifically to the mark to market. Are we going to violate the policy? I think we all know why we're having these policies because of the long-term higher return. We're managing that risk for mark to market. And this mark to market conversation is why we have not asked to go out in duration for the general account further. Because then we have even greater volatility, more potential for mark to market for the larger chunk of our money. So we can manage that risk based on where this portfolio is and give higher returns. Does that
That's my question,
address
yeah.
it? Thank you.
It does. Thank you.
So that's exactly one of the reasons why we chose to go with the M&O and the longer duration strategy a few years ago when rates were extremely low, because we did recognize the risk that rates could back up, and indeed they have. So moving on to slide 12, we see the longer term returns as well as the shorter term returns. The longer term returns for the general account are consistent with what we'd expect relative to the index, and as Alan mentioned, on an absolute basis, where they're just over 1% over 5 years, and we are seeing a bit of alpha or added value with our strategy and the approach we take in the management of that portfolio. Moving on to slide 13, we do recognize there's additional volatility here. We also recognize the transition that occurred a couple of years ago as we moved this portfolio from a shorter duration, shorter maturity strategy out to a longer duration, longer maturity strategy. We have not seen the fruits of this given what's happened in the markets and what's happened with rates. But again, we want to emphasize that we do take a longer term approach, and we appreciate your patience and your acceptance of this. Moving on to slide 14, I will turn this over to Alan again.
Hold on 1 second. So slide 13 concluded the investment presentation. Starting on slide 14 is supplemental information that we that's provided by Alan and his team. So we can certainly address any one of the supplemental information slides or all of them, at your discretion.
Thank you.
Deb, if I may, we do typically speak to the trade allocation by dealer, which is slide 16, and we note that generally have some diversification across the dealer spectrum, and dependent upon what we're trading at in any given quarter, we may see a little bit higher concentrations. FHN at the top has gotten much more competitive the last couple of years. And so we see them winning competitive bids offers on a more regular basis. And that's certainly borne out up here at the top of the table. Thank you.
Member Rosen, with that, that concludes the investment committee update and request for approval to continue with the current strategies. Unless there are any further questions that collectively we can answer.
You're talking about, you're seeking, it's listed as an update. So what you're,
So yeah, this one's always a tough one, right? Because the vast majority of this item is an update, right? They're telling you what's going on with the market, what are we experiencing, what is our compliance, the fact that we're in compliance, what are we seeing with our own performance. So a lot of this is an update, but there's one element that's an approval item, and that is your support or concurrence or approval that we continue with the current strategy for the losing my thought, for the non matched funding, the total return accounts. So if I could refer you to slide, I'm sorry, let me just get there. Slide 10. So slide 10 in the box, talks about our current strategy. And so we're looking for your concurrence to continue with that strategy. Upon your concurrence or approval, Alan will present this at the full board for the full board's approval to continue the strategies that we have in place.
okay, I guess we can carve out that, but I think it's either, are you there, Deb?
Yes, I am.
I guess I think it should be listed. I don't know how we address this in the future, but the item is either an update or an approval. If we're gonna seek approval, I think it should be listed that way. I mean, I guess we could specifically carve out. I don't know if anybody else wants to weigh in on this.
To Member Von Paris's point, Deb, if you don't mind me jumping in here for a second, I think item 5 on the agenda reinforces the actual approval portion of what you're requesting. It's just that slide 10 kind of neatly packages what that investment strategy means in terms of numbers. Is that a fair way of saying it, Deb?
It actually isn't, only because this is the month, once a year, we bring the investment policy for an approval. So what we will do in the future is the investment committee report, the quarterly report out for investment committee. We will change that to an approval item. The presentation will be the same. We will give you the update piece of it, so you have the information that you need in order to make an informed decision when we ask you for approval on the strategy. But we will label that as an approval item. And then the next item is separate. It is the policy, just as you approved the debt policy a minute ago. This is the approval of the investment policy.
Okay. Well,
hi, it's Meryl Dunlap jumping in here. It was not listed as an approval item. It was just listed as an update. So if there's another way to do it at a different point in time, that would be best.
Yeah, we generally just make a recommendation to move to the full board for approval. So I think what we're seeking at this point is the concurrence of the finance committee with the ongoing strategy and to move forward to the full board for the board's approval, the board that needs to make this approval.
So for agenda purposes, can we, we'll call this a concurrent.
I concur.
I concur.
Okay. Okay, well then, we will, we'll proceed that way. And Merrill, that's, you're good with that approach?
Is there anything time sensitive with regards to it?
No. No, there is not.
So I
Yeah,
guess
it-
just to recap what we're saying, Merrill, I think, is that at the full board, we'll bring this as an approval item, and through the update, we haven't heard any discussion that would influence us at that approval to make any amendments to the policy. So I think, the discussion has sort of shown that what we will submit as the approval item at the full board would match the existing policy.
Okay, so we're just
Okay.
moving it forward to the full board for them to vote on it at this point. Okay, that's fine.
That's
but in the
correct.
fu- But I agree, in the future, go ahead and list it on the agenda as an approval, or in part.
Yeah.
Thank you.
Okay.
Thank you for your concurrence on the strategy. Okay, sorry for that little bit of confusion.
Yeah, I just think, this is, yeah, I think it's a very important item and deserves to have a listed, I guess, as an approval item. So I guess at this point, we're going to seek or advance this to the full board for further consideration. Is that fair? Is there a motion?
So,
No, we need a motion. Member Von Paris, I'm sorry. We don't need a motion. Hearing the board members concurrent is sufficient, and we will present this as an approval item at the full board.
Okay,
So if-
all right.
so if the board members,
All right, so-
don't have any other questions, I think we could move on to the next agenda item if you are ready.
I am. I was just a little confused by where we were with this. So we're just gonna, it's an update, and board will deal with this it'll be dealt with at the board meeting. Full board. So we'll move on to agenda item 5, the approval of the investment policy.
Thank you. This is Clayton again, the investment administrator for MDTA. We are presenting the investment annual review of the investment policy this morning. And note that the purpose is to request a recommendation of the Finance Committee to present to the full board for approval. That being said, there are no material changes to the investment policy this year. There is one technical change or modification that we have made to the policy. You have a copy of the policy in your packet, I believe, and that change is on page 1 of 10 of the policy. So it should be 2 pages back. And what we have done is edit or add section 2, the reference to section -6-222 of the state finance and procurement article. That is the sole change that we have made this year to the policy with the review and sign off, if I may, of the investment committee at its last meeting. The investment policy discusses security type limitations. It discusses maturity limitations, as well as diversification and issuer sector. It also speaks to reporting requirements and what should happen in the occasion of policy violation or downgrades. Alan, would you like to add anything?
Yeah, I guess just on the statutory reference, we're just making a correction. You know, the statute had changed, so it's just a minor correction. I think one of the things that we highlight in the policy is that specifically in that section is that we're not bound by that section of the statute. Our monies are independent from the state of Maryland, so we have authority to manage our own funds. But it's worth noting that our investment policy is, derived from the trust agreement that sets forth limitations as well. And that trust agreement is fairly close to the state statute as well. So even though we're not bound by that statute, our policy and the trust agreement are modeled after it. So it's relatively close. So I think that's all I have to add.
Thank you.
All right. Any further questions from board members on this item? Is there a motion to advance this item to the full board for consideration?
Member Ardinger, I so move.
Thank you, Member Ardinger. Is there a second?
Second, Member Carroll.
Thank you, Member Carroll. We have a motion and a second. Any further discussion? Okay, all those in favor?
Aye.
Opposed? Motion carries. Thank you very much.
Thank you for your time.
Thank you. Thank you all. I wanted to thank all the presenters today who handled all the agenda items, and just think that we have a great team at MDTA, and I think we saw a lot of that today right here. So much appreciation for that. That concludes our meeting, and I thank all the members for attending. And is there a motion to adjourn?
So move.
Thank you, Member Rosen. Thank you, Member Carroll. Motion and a second. All those in favor?
Aye.
Opposed? Motion carries. We stand adjourned.